Welcome to TheoTrade. This is Don Kaufman. It's January 14th, 2019, and you are watching the TheoTrade evening video. Well, welcome to earnings season, and welcome to a trading day where, there's still about 50 minutes left in the trading day, but it is light out there, folks. What do I effectively mean by light out there? Well, first of all, the S&Ps, they've had a decent range on the trading session, but I mean, come on, we're doing 936,000 contracts, really? So whatever you're seeing in terms of action today, there's effectively nothing behind some of that action in the trading session. There's just no volume really substantiating some of the moves that you're seeing on the screen. I've been watching some individual stocks throughout the course of the day. Amazon, which is once again kind of been Mr. Toad's wild ride, off the $15.95, shot to $16.45. Yeah, that's $50, people, only to give, well, at least half of that back. And the reason I'm bringing Amazon to the table, there's a couple of individual products here, right, that are either a drag on the market, that are actually moving markets like Amazon, simply because, well, there just isn't a tremendous amount of activity elsewhere, which we thought this kind of the perfect and kind of quintessential time to talk about, well, earnings. So welcome to earnings again and some earnings related trades. I am going to go into detail about some earnings and earnings related trades here momentarily. And we're predominantly going to use Netflix for an example. Why? Because it's just a high flying, fun loving widow maker of a stock around earnings. And I say it's the widow maker of stock around earnings. You know, my experience and all my years of experience in the brokerage industry, specifically at both thinkorswim and TD Ameritrade, I can't remember any other individual equity product, and I really mean this, individual equity product that did more damage to traders than Netflix, specifically to premium sellers than Netflix. Now, before I get into some real specifics of earnings and earnings related trades, I'm going to close that up. We're going to cruise over to a scan. I just built a really quick scan here on thinkorswim. If you don't have thinkorswim, it's fine. There's earnings calendars everywhere. But here, well, here's what I like in my earnings scans. First of all, I like to scan just in weeklies. What is weeklies? It's stuff that has weekly options. And all the time people go, why don't you scan in the S&P 500? Well, because not everything is necessarily liquid in the S&P 500. Not everything is necessarily liquid in the weeklies either, but I like them. All right. And when I highlight this under weeklies over here, it's because I'm scanning in the weeklies. The next thing, I'm just adding, okay, what we term a study filter, earnings. Has earnings anytime in the next 4. Now those bars are defined as days. That's it. That's what my scan is. We hit scan the results. There's 21 of them in the next 4 days. Look down the list at, some of the usual suspects. Now, one of the first things that we want to cover before we actually get into the context of specifically like, hey, I've got a trade on for earnings, or I want to place a trade. As we said, we're going to be talking about Netflix. Run down the list. Do you have any positions in any of these underlyings? I know I do. As I look down the list, I've actually got a position inside of CSX. I've got positions inside of JP Morgan. JP Morgan, well, all right, I could take a look right now. Tell you that's coming out tomorrow morning. One of the first things I want to decipher. I want to come back over to the trade tab, type in JPM. Now, each and every one of you may, feel a little differently about this, but when you have a position on, whatever that position is, whether you're long stock, whether you're short stock, are you capable of holding that position through earnings? Now, how do you even be able to begin to discern that? Well, look to the expiration that is going to host the earnings. In this particular case, it's the January 18th options, right? This week is expiration. This is going to host the earnings. Look at the expected move. Take the expected move, right? And look at it. It's $3 and about 20 cents. Can you handle a $3.20 move inside of JP Morgan? But that wouldn't be enough. What you would rather do is you'd rather take the expected move, okay, and kind of multiply it by the delta of your position. In most cases, let's just say, for example, that you had 500 shares, okay, of JPM, 500 shares of JPM. Take that, okay, and effectively multiply it. Let's just put it in this case by $3 to make it really easy. All right. And you have to ask yourself at that point in time, because this is what's expected. What's expected? That's, the norm. are you willing to sustain in this particular circumstance, okay, the 500, shares of risk times 3. So you're looking at a plus or minus or a profit and loss variance, okay, in excess of about $1,500. But then the reality is to really give yourself a good feel for what is possible in and around the earnings, take the expected move and effectively double it. So in this particular case, you could put it at $6, even $6.50 would be fair. Okay, and for ease over here, I'll just put it right at $6. Take the $6, okay, multiply it by the number of shares. All of a sudden brings your profit and loss, okay? This is P&L variance for just this week. Just this week, the P&L variance is around plus or minus $3,000. Now ask yourself, can you handle that? Go fish. Whenever I say go fish, like, hey, can you really handle the risk of plus or minus $3,000? And if you can't answer that, quickly, you got yourself a problem. You're probably not going to want to hold that position through earnings. Now, something like JP Morgan, okay, let's not fade JP Morgan just yet, but that one's pretty easy to handle. When you start looking at something like Netflix, oh, come on, $30. $30. You have 100 shares of this. You're going to be taking $3,000 profit and loss variance, almost guaranteed. Think about that, because when it's saying, hey, we're likely to move $31, we're going to move $30, right? That's really what it's saying. Now you got to take that and double it. That's a $60 move. If you can't wear a $60 move inside of Netflix, you have no business carrying a position through Netflix and through its earnings. With that, that's one of the first things I want to get to when it comes to earnings trades. Again, manage the risk that you have on. Why? Because if you can't manage the risk that you currently have, how do you think you're going to be able to put new positions on? Okay? You can't possibly function in the midst of an earnings period or in the midst of volatility when you have too much risk already on in existing positions. Next, let's take a look at different types of earnings trades. When it comes down to earnings, there's so much chatter about earnings, and people spend, literally countless hours discussing earnings and earnings trades. There are really 4 earnings trades. What can you really do around earnings? And I'm going to show you. Number 1 over here, you can get what? Okay, you can get bullish. Number 2, what else could you do? I'm not bullish. Okay, I want to be bearish around earnings. Number 3, what could number 3 possibly be? All right, this is neutral. And there's 2 different types of neutral. We're going to talk about first neutral, what we call short. Number 4, okay, is neutral, what we term long. So what does this effectively mean? Neutral short, neutral long. Neutral short is selling options, okay, hoping that we stay inside of a $31 move. Neutral long is buying options, hoping we typically move outside of what expected move. So let's just show you a couple trades. Let's cut to the chase. Now, again, I've been doing this over 20 years now, and constantly during earnings, people are like, well, I did this, and I did, this trade, a triple naked backflip trade, and then I turned around and did a calendar spread and a double calendar and a double diagonal straddle strangle swap. Yeah, you know what? Doesn't matter what you do. It fits into one of those 4 categories, period. You want to get bullish? Okay, let's get bullish. All right, here's your bullish trade. Don't overthink it. Don't overthink it. That's it. Boom, done, bullish. Okay. Go over to the Analyze tab, and I was playing around with a couple of trades earlier. Go to your Analyze tab. There's your bullish trade. Yay! You want a bearish trade? All right, we'll delete this one out. Do the exact opposite. What's the bearish trade going to look like? I'm just using an in-out spread. When I say don't overthink it, listen, one trade's bullish, one trade's bearish. I don't want to extend myself into huge amount of risk. And if you don't like, listen, if you don't like the idea when I hit confirm and send, you're like, but I only have $120 at risk. Well, if you're really, really bearish, do more contract size. There's no reason to overextend yourself. Just do a couple of more contracts. And if doing a $2.50 wide spread isn't enough, I don't know, let's get crazy. Let's do a $5 wide spread. Okay, fairly easy. There's a bullish trade. There's a bearish trade. Again, without overextending myself. Now, a little bit more complicated. Look at the expected move. Let's open up about 50 strikes, and let's get to work over here. So what's about $30 out of the money from here? That would be about the 360. So I'm going to go a little further outside the expected move. I'm going to go to the 370. maybe turn around and buy something like the 375s. That's a $5 wide call spread that I'm selling for about 71 cents. But at the exact same time I'm going to do that, I'm going to make the trade like net neutral, about $40 out of the money. Go to the 290s, maybe the 285s. Boom, there you go. It's an iron condor. You like it? Analyze it. What am I? This is a neutral trade. Okay, forget about the bullish trade and the bearish trade for a second. Here's your neutral trade. What have I done with my neutral trade? Okay, here we are right in the middle. I sold some junk out here. I sold some junk out here. Then what do? I pray. What's the prayer about? It's about stay inside the expected move. What's the expected move? Plus or minus $31. I just gave myself a little bit more room to the outside of that. Now, if you want to get really cute, that again is your neutral short position. You want to get really cute? Come over here and analyze the opposing trade. That is, instead of neutral short, you buy the iron condor. Okay? Now, because I brought up 4 different trades, which you're going to see later and throughout the course of the week, right? For those of you that have access to the TheoTrade chat room, we're actually going to go in and we're going to do some in-depth trades. We're going to select and say like, okay, this is why we're doing a bullish trade, or this is why we're doing a bearish trade, or this is why I'm selling premium, this particular earnings period. But when it comes down to it, make the earnings trades easier on yourself. It's just one of 4 things, no matter what you might hear. Okay. And again, a lot of people think that, well, Don, I could sell 107, or 101 vol and buy a 74 vol. Really? Because what you'll find out when you actually get into the understanding of options, yes, this is 100% volatility. Okay. However, if you look at Vega is an option sensitivity to changes in implied volatility. As soon as an earnings announcement comes out, okay, we know that the volatility is going to drop. And what a lot of people do, and this is kind of a fun one over here, but what a lot of people do is they turn around, okay, and they sell options here, okay, and then they buy options here. The problem is, yes, this volatility will go down. It'll go down faster. But these options are impacted, okay, by much less than the option that you own. So looking at one volatility versus another, okay, is completely and utterly misleading. It's not fair for people to interpret that this volatility, yeah, sure, the volatility drops more, okay, but it's worth less to each individual option. Whereas the option that you own, okay, the volatility has much more exposure out there, and that's the sensitivity, again, to what we term Vega. So no matter what you want to call it, okay, in the end, it breaks down to one of 4 trades. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.